Welcome back to Investing Talk podcast.
Today, we are looking at a company that is arguably the most critical yet overlooked player in the entire AI ecosystem.
Okay.
We spend all our time talking about the brains of the operation, the NVIDIA chips, the software, the processors.
That flashy stuff.
Right. But we almost never talk about the nervous system, the spine. Today, we are doing a deep dive on Amphenol.
As usual, before we start, subscribe, like, and comment to this video to support the show. Now, you called this the nervous system of AI.
Mm-hmm.
But let's be real for a second. When I look at Amphenol, I see a company that makes connectors, sensors, cables. It feels incredibly industrial.
It does.
It feels old school. Why should anyone care about a company making plugs and wires when we have these high-flying chip stocks returning triple digits?
That is exactly the trap. That's the trap that 90% of the market falls into. They hear connector and they think commodity.
Right, like an HDMI cable.
Yeah, exactly. The one plugged into their TV. But you have to completely reframe what a connector is in the age of AI. We are not talking about plugging a lamp into a wall.
Okay, so paint the picture for me. What are we talking about?
We're talking about modern data centers. Inside these places, you have clusters of GPUs, each one costing tens of thousands of dollars.
Okay.
They're processing data at speeds. I'm talking 800 gigabits pushing toward 1.6 terabits that are just physically difficult to manage.
So at those speeds, physics gets weird.
Physics gets very weird. Electricity creates massive heat, massive interference, and if the physical connection between that GPU and the motherboard has even a microscopic imperfection, you get signal loss.
So it's not about power, it's about the integrity of the signal.
It's all about signal integrity. It's physics. If that signal degrades, the whole cluster slows down. Latency spikes. And in a billion-dollar AI training run, latency is literally money being incinerated.
So Amphenol isn't just selling a cable.
No. They're selling the guarantee that data moves from point A to point B without losing a single bit. They're the only thing stopping these supercomputers from just being expensive space heaters.
That puts a very different spin on it. If the connector fails, the multi-thousand-dollar chip is useless.
Precisely. Amphenol isn't riding the hype train. They are building the actual tracks that the train runs on.
Okay, I'll grant you the mission-critical argument. The tech sounds essential. But I'm still the skeptic here.
I know.
A great narrative doesn't always equal a great investment. Is this actually translating to the bottom line? Or is this just a boring industrial stock rebranding itself as a tech darling?
The numbers are absolutely translating. In fact, they're exploding. Let me hit you with a headline number from their Q4 2025 results.
Go for it.
Their IT datacom sales, the specific part that serves these AI data centers, surged by 110%.
Hold on. 110%.
More than doubled.
In a single quarter.
In a single quarter.
Yes, that is startling. I mean, with industrial hardware, you're happy with high single digits. Doubling revenue in a key segment suggests a paradigm shift.
It's a jaw-dropping signal. It tells us the demand for physical AI infrastructure is accelerating, not slowing down. And this isn't just one lucky quarter.
Right.
If we look at the whole picture, Q4 sales hit $6.4 billion total. That's up 49% in US dollars year over year.
Wait, nearly 50% growth for the whole company?
Yeah.
Because usually a spike in one cool segment like AI is masking rot elsewhere. AI is up, but automotive is crashing. Is that happening here?
That's the crazy part. It's not. Even if you strip out acquisitions, strip out currency changes, their organic growth was still 37%.
37. That's massive for a hardware company of this size.
For the full year 2025, revenue hit $23.1 billion.
But you're talking about a company doing over $20 billion in sales, scaling like a software startup. But what about the backlog? In hardware, revenue's great, but if orders dry up, the stock tanks. What's the demand pipeline look like?
It's even stronger than the revenue. In Q4, they booked record orders of $8.4 billion.
Okay.
But here's the metric I really want you to focus on. The book-to-bill ratio. It was 1.31 to 1.
Okay, let's unpack that for listeners. Book-to-bill measures orders coming in versus product going out.
Okay.
1.0 means you're just treading water.
Right, and a 1.31 means for every dollar of product they shipped, they got $1.31 of new orders coming in. They have customers lining up.
So growth isn't a flash in the pan. They have the future locked in.
That's what it tells us.
That's a strong indicator.
Yeah.
But let's pivot to profitability. A lot of times, companies grow this fast by just burning cash. They kill their margins to grab market share. Is Amphenol actually making money on this?
They're printing money. This is where Amphenol really separates itself. They beat earnings expectations in Q4, hit 97 cents per share. But the real story, the one that should make your ears perk up, is the margin.
Okay.
Adjusted operating margin reached a record 27.5.
27.5 for a manufacturer.
Yeah.
That's absurd. In this sector, making cables and sensors, you are usually fighting for 12, maybe 15% if you're good. 27.5% is software territory. How are they doing that?
It implies massive pricing power. They are not in a race to the bottom. They are selling premium, highly engineered tech that customers think Microsoft, Google, Amazon cannot afford to skimp on.
Right. If you're building a billion-dollar data center, you don't buy the discount connector.
You buy the Amphenol connector because you know it works, period.
That leads me to the how. We've covered the connectors, the margins, but how does a company with 90,000 employees move fast enough to capture this AI wave? Big industrials are usually so slow.
This is the secret sauce. This is the real moat of Amphenol, and it's not technology, it's organizational. They operate under what they call the entrepreneurial model.
I've heard this term. It sounds like a corporate buzzword. What does that actually mean?
It's the anti-corporate structure. A traditional company of this size has layers of management, right? Every decision goes up and down a chain. It takes months to pivot. Amphenol doesn't do that. They have about 145 general managers.
145.
Yes. And each of those GMs basically runs their own little company under the Amphenol umbrella. They have their own P&L, they control their own hiring, their own R&D.
So instead of one giant aircraft carrier, it's a fleet of 145 speedboats.
That is the perfect analogy. And think what that means for AI. If the GM of a high-speed interconnect division sees a new need from NVIDIA, he doesn't write a proposal and wait 3 months for HQ to approve it.
He just does it.
He just reallocates his budget and builds it.
That explains the agility.
Wow.
While competitors are in meetings, Amphenol's managers are already prototyping.
And it creates extreme accountability. You own the P&L, you can't blame corporate. This structure drives that 27% margin because there's no bloated middle management.
Fascinating. It's decentralized command.
Yeah.
And I assume this plays into their acquisition strategy too, right?
Yeah.
Because they just made a massive move.
A huge move. We have to talk about the CommScope deal. They're spending $10.5 billion to acquire a huge chunk of CommScope.
That is a massive bite, even for them. Why CommScope? To me, they feel like legacy telecom, 5G towers, older tech.
It's all about the next bottleneck. Right now, we use a lot of copper for connections. Copper is great, but it has physical limits. As speeds get higher, it generates too much heat. The future of data centers is optical, fiber optics.
And CommScope has the fiber tech.
CommScope is a giant in fiber. By butting them, Amphenol is future-proofing. They're saying we dominate copper interconnects today, and we're buying the tech to dominate optical interconnects tomorrow.
So they are cornering the market on physics. Electricity or light, they want to own the path.
Precisely.
Okay, fundamentally, the story is incredibly strong. You've sold me on the business, but we're buying a stock, not just a business. Let's pivot to the charts and price action. Where does the stock stand right now?
It's in an interesting spot, trading around $144, but context is key here. It's actually down about 14% from its all-time high of roughly $167.
Which begs the question, is this a falling knife or is this a discount?
Well, I look at the moving averages to see the trend. The 50-day moving average is at $141.27, and the 200-day is way down at $128.54.
So the short term is well above the long term.
Right. Technically, we're still in a golden cross. The primary trend is up.
So this pullback is more of a consolidation, not a crash.
Exactly. And look at how the market reacted to the earnings. The stock popped almost 7% immediately. That tells me buyers were waiting for good news to step back in. The buy the dip crowd is active.
And it's moving with the sector. Supermicro, Jabil, Vertiv, all these infrastructure plays are trading together. It's broad strength. But let's talk about sentiment. What's the market mood?
It's shifting. For a long time, Amphenol was seen as a boring industrial. Now you're seeing it pop up on JARP list growth at a reasonable price. You're seeing analysts upgrade targets. Barclays is at $175. Truist is at $182.
So the street sees another 20, maybe 30% upside from here.
Yes. The narrative is changing from cyclical factory stock to long-term AI compounder.
However, I need to stop the love fest for a second.
Uh-oh.
Because there is a piece of data here we cannot ignore. And honestly, it makes me nervous.
The insider selling?
The insider selling, specifically the CFO. In the last 90 days, the chief financial officer sold 258,000 shares. That's a transaction worth about $54 million.
It is a massive number.
It's a huge number. Look, I know executives sell stock, but $54 million, that is not, I need to pay for a renovation.
Yeah.
That is, I am cashing out. The CFO knows the numbers better than anyone. If he sees these incredible margins, the backlog, this whole AI revolution,
Yeah.
why is he taking $50 million off the table right now?
It's a valid concern, and we shouldn't gloss over it. When a CFO sells that much, it can signal they believe the stock is fully valued, at least in the short term. They might think the price ran up too fast.
Exactly. It feels like a top signal to me.
However, you have to weigh that against the other side of the trade. While the CFO is selling, who's buying? The so-called smart money, the institutions.
No.
Renaissance Group holds Amphenol as a top 10 position. Financial management pros just increased their stake by over 82%.
So we have a tug of war. The insider is selling to the institutions.
Correct. And in this case, I tend to lean toward the institutions. Insiders sell for lots of reasons: diversification, taxes, life events. Institutions buy for only one reason: they think the stock is going up.
Okay, I'll accept that, but listeners should definitely keep an eye on it. Let's bridge to the risks. We have to look at the bear case. We mentioned the CommScope deal as a win, but what about the execution risk?
It's the classic M&A trap, integration headaches. And here's the kicker: CommScope's margins are lower. They operate in the high teens. Amphenol is at 27.5%.
So just by doing the math, the moment that this deal closes, Amphenol's overall margin drops.
Yes, there is a dilution effect, and investors hate seeing margins contract. The bet is that Amphenol can work their magic on CommScope and bring those margins up, but that takes time.
And it could get messy.
Very messy. If they stumble, the stock will get punished.
And then there's the valuation, a PE ratio around 33. Historically, for an industrial company, that is nosebleed territory.
That is the core debate. If you see them as an industrial, 33x earnings is expensive. If you see them as a critical tech infrastructure play, 33x is actually pretty reasonable.
But if the market sentiment shifts, if the AI hype cools off, Amphenol could get re-rated back down to an industrial multiple.
And that would crush the stock price even if earnings stay good.
Exactly.
If the market decides they're just a cable company again, the multiple collapses.
Okay, so we've looked at the explosive growth, the unique structure, the technicals, and the very real risks. Let's wrap this up with the final verdict. What is your score?
I am giving Amphenol a bullish score of 9 out of 10.
A 9. That is incredibly high, especially with the insider selling we just discussed. Walk us through the final thesis.
It comes down to inevitability. Big tech is planning to spend $650 billion on AI CapEx in 2026. That is a tsunami of cash.
And a big chunk of that has to go to physical infrastructure.
It must. You cannot build these systems without what Amphenol makes. They are the toll booth on the road to AI.
Right.
We have 110% growth in their core AI segment. We have record margins proving their pricing power. And with the CommScope deal, they're locking down the next generation of fiber optics.
And what does that mean for the stock price?
Based on conservative growth models, I see potential upside to $193 over the next 3 years. That's roughly a 34% gain from here. And if the AI boom accelerates, it could be much higher.
So the recommendation is to hold through the volatility.
It's a multi-year hold. This isn't a trade for next week. It's a compounding machine. You buy it, let the 145 general managers do their jobs, and you watch the cash flow grow.
It's a compelling argument.
Yeah.
It's easy to get distracted by the flashy chips, but the plumbing is where the steady money is often made.
And one final thought for the listener. We spent this whole time talking about AI, but remember, Amphenol also dominates military, aerospace, and automotive. Even if AI vanished tomorrow, do you think the world will need fewer missiles, fewer electric vehicles, fewer commercial aircraft?
Probably not.
This company has multiple engines. AI is just the turbocharger kicking in right now. The diversification is the safety net.
That is a great point to end on. Diversification is the only free lunch in finance. That brings us to the end of this deep dive. As usual, subscribe, like, and comment to let us know which stock we should break down next.
Thanks for listening.
We'll see you next time.